Moving on, the ongoing oil crisis courtesy the US-Iran face-off has put India in a tight spot. Many investors, along with FIIs, are tracking how India will sustain its growth story in FY27. ET Now's Ankur caught up with Moody ratings, Rate and Vikash Halan, along with ICRA's Ravichandran. Listen in to a slice of that riveting conversation.
From our view, actually, we think that the credits that we cover, they are quite resilient to the impact, for various reasons. And there's the answer is not homogeneous because it depends on the sector that we cover.
Definitely.
Our largest coverage is the power sector, and actually a lot of this coverage relates to renewables or regulated utilities. So in terms of renewables, as you can understand, in this time, during this time in particular, actually renewables do come across as a little bit more competitive, right?
So today Finance Minister did mention about infrastructure finance, about credit growth, where we ended in FY26. But overall, ever since the West Asia crisis started in March, that is where we have to assess how much of the impact in each sector is going to be there. And you can start with your assessment.
Yep, sure. So for renewable energy, for example, it could stand to benefit, especially projects which are already operational or under construction with defined financing and equipment prices. The question is actually looking forward, because we are in a generally inflationary environment, so the cost of financing as well as equipment costs could rise as a result. So that is one factor that we are watching. For the other sectors that we cover, in terms of, for example, we cover GAIL, and we do look at it as being exposed, but the issuer does have very, very strong financials. And that's the case for some of our issuers where there is some impact. For example, the airport, we cover Delhi Airport, but the financials are actually stronger relative to the credit quality or the rating that we have assigned. The other sector that we cover are the ports, and we think that despite this impact, we think that the ports, in terms of trade and everything, they're still holding up fairly well, and we will need to watch and see. It depends on the duration and of this situation.
Definitely, duration is something which everybody is guessing, and that is something which is very difficult to predict. But till now, whatever we have seen so far, what is the study you have done in terms of balance sheets? How much time will it take to take that hit? Is there any assessment?
Yeah, at ICRA we have done a detailed assessment of Indian companies with regard to West Asia impact. Fortunately, we are entering this crisis with a very strong balance sheet. Most of the Indian companies are deleveraged because of the buoyant profits over the last 4-5 years, and also they were able to raise capital, and because of that, balance sheet leverage is at fairly low level. But having said that, earnings will take a hit in the next 2 quarters. March quarter didn't reflect the pain, but we believe the pass-through of energy and metal prices will be seen, in the earnings of airline companies, fertilizer companies, oil and gas companies, many MSMEs, ceramic tile entities, and so on and so forth. Through cost push inflation and rupee depreciation, we believe earnings will be taking a hit in the next couple of quarters. But whether it will result in significant credit quality pressures, that is something is not that straightforward, because of the fact that there is a lot of cushion available to absorb this earnings shock, except some badly hit sectors like airlines and fertilizers, etc., where the losses could be somewhat deeper. But even there are companies who are really strong from that point of view. Their ability to raise capital is at fairly good level, and they should be able to sail through this difficult period. But key thing for us to watch is how long this crisis will prolong. In case,
that is the bigger question. That is the bigger question, and there I want to come to you, Vikash. If crude prices remain in this trajectory for longer than anticipation, or if it crosses the key mark of, let's say, 120, 130, we don't know, then how much of the impact will be there on India Inc.?
So it's two parts to that. One is, of course, the supply side and the supply shortage, and the other is the price shock. On the supply side, India has been fairly good so far in terms of making sure that the crude availability is being managed. And most of the refineries that we speak to have been able to get their supplies till June, July. All of the supplies have been tied in. When you think about what was the shortage to begin with, there was close to 2.5-3 million barrels per day of shortage, because that was the crude that was coming from Middle East. And on top of that, there was some exports that India were doing. So on a net basis, you could say that India was 2 million barrels short. So how that shortfall was plugged was, of course, you had some degree of supply coming in from Middle East. So Saudi Arabia had the Yanbu port, UAE had the Fujairah, and you had Venezuela crude coming in, and you had Russia supply increasing. So India's shortfall compared to the overall, the market was still just about 2%. So it was something that was more manageable compared to some of the bigger shortfalls relative to the market size. So from that perspective, the shortfall has been managed, but if the crisis is longer or the disruption is for long and without resumption of the supplies from Strait of Hormuz, which is not the base case that we work with, our central scenario assumes that there is going to be resumption in a gradual way, and we will start to see a lot of the disruption starting to dissipate towards the end of the year.
Right.
If that were to play out, we don't see that the prices will be hitting the 120 that you were saying, but it will still be averaging between 90 to $110.
The RBI has assumed at $85 and next year it is 95. That was in last monetary policy, but so many things have changed even since then.
Exactly. I mean, even if the Strait of Hormuz opens now, you're going to see prices not coming down very rapidly, because there is a lot of reserves that have been drawn down over the last 3 months, and those reserves will have to be replenished. So even if you see supplies resuming, the demand will be actually a lot more than what we are seeing today. Therefore, our expectation is $90 to $110 for the rest of the year, as per our central scenario. And that is assuming that the Strait of Hormuz opens up, sometime towards September, October, or there's a gradual resumption of flow from there. Now, coming to what happens to the India Inc. In such a scenario, so far India has been fairly resilient in terms of supply side.
Right.
And also, if you see in terms of the price transmission that has gone to the economy, has been fairly moderate. For the first 2 months, of course, there was no price transmission to the consumer. There has been some transmission that has started. So the effect on inflation and what we see, what are the effects of inflation beyond that is discretionary demand coming down or interest rates going up. That there is no sign of that yet, but if that were to happen, you would see the discretionary spending coming down, construction, real estate, automobile. You would start seeing effect on those numbers, but we haven't seen that yet. So until such time, you don't see inflation expectations going up, resulting in discretionary spending getting deferred, or government's construction spending deferred, or infra spending deferred. We see the impact on the Indian corporates to be fairly mild.
That is good to hear. Coming to power, and in power particularly, we are at a time where AI is there, electrification, renewables, all these factors are into play at a time when this crisis is there. I want to understand from you the scenario which you see in next 5 years.
Right. So when it comes to data center, we view the Indian data center market as one of the fastest growing in the region. We do expect actually data center capacity to double to 2030, and that means it's a jump from 1.2 gigawatts of operational capacity now to 2.4 gigawatts, let's say. We view actually that the Indian power system is actually able to accommodate this growth. And that's because actually the Indian power system is about 520 gigawatts as of March this year, right? And in terms of renewables as well, this country is leading in terms of pushing renewable energy implementation, and that's also the source of energy that data centers and hyperscalers would want to actually avail themselves of. So we actually think that, and plus also corporate PPA market here is pretty vibrant. So all this taken into consideration, the kind of growth, even though phenomenal, but still a small percentage, we reckon, of energy consumption for the overall power system here, we think actually that can be accommodated for here.
Definitely, and keeping with the same question, which are the bottlenecks which you are seeing for the next 3 to 4 years?
See, the biggest challenge that we see is on the transmission side. While a lot of awards have happened on the renewable energy, of late you would find mostly in round the clock FDRE and battery storage and so on and so forth. But this has not been matched on the transmission side. The projects are getting delayed on account of the fact that land acquisition is the biggest challenge, and getting approval is another problem for the developers. Because of that, the central counterparties like SECI, they are not able to conclude the power purchase agreement with the off-takers, that is DISCOMs. There has been a stalemate over here. There has been delay in concluding power sale agreement with the central counterparties, and in turn they are not able to conclude the PPAs with the DISCOMs. So key thing to address here would be to speed up the transmission projects. That is number one. Number two, on the DISCOM finances per se. While over the last 2 years there has been significant improvement in the financials of these entities, thanks to tariff increase and support received from PFC, REC, etc. in the form of debt funding. These days they pay most of the developers on time. The receivables have come down quite a bit. But how far that is sustainable, that is a question mark. Because even now, if you see the tariff increase, actual tariff increase is only 1 to 2%. Right. Large part of the improvement is on account of subsidy payment by the respective states, in advance, because of the intervention from the regulators. So key thing for us to see whether cash losses will come down to meaningful levels, and the gap between average cost of supply and average realization goes down to meaningful levels. So these two are the biggest challenges that ICRA foresees.
Yes, is India ready for the next phase of growth given the ongoing crisis? That was the question that we were asking in that discussion. And with that, it's a wrap on this edition of Business at 9. Goodbye from me, Shivani Kharat, and the entire team of ET Now.